Hi there. Thank you so much for joining us today. My name is Marche Butler. I'm the webinar director here at Advice Chaser, and we want to welcome you. Before we introduce our guest and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions and put comments in the chat box. The presenter will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. And if we can't get to your question during the event, we'll make sure someone reaches out to you after today's event. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'm just going to go ahead and make sure the chat is turned on so you can chat with us. Very good. All right, well, I'd love to introduce you to our speaker today. And let me get her picture up. Darcy Smoot is a principal with Nelson Capital. She has extensive experience in equity analysis and securities trading. Darcy graduated with a BA from Swarthmore College, majoring in mathematics and English literature. She began her career at Bloomberg LP in New York City, and in 2009 went to work as an equity derivative sales trader at Susquehanna International Group before joining Nelson Capital in 2014. Darcy is a chartered financial analyst and is a member of the CFA Society of San Francisco. And Darcy, we're excited to have you here, and I'm going to go ahead and turn the time over to you. Let's get into this.
All right, thank you, Marche, and thanks to everyone who is joining us. We're going to talk today about three main vehicles to save for future education, or excuse me, future expenses, including higher education, which is, of course, one of the biggest for children. So starting with the first vehicle, which is the 529 plan. This is an educational savings plan. Of the three vehicles that we'll talk about, it is the most geared toward educational savings specifically. So this vehicle helps parents save for their children's education. Some states actually offer a tax incentive or a tax deduction for contributions to a 529 plan. I'm in California, and unfortunately, California does not, but it is worth investigating based on wherever you're located, if your state does offer that tax incentive for contributing to a 529 plan. The funds in the plan grow tax deferred, so the earlier that you start contributing to a 529, the greater the benefit, of course, assuming that markets generally rise over time. The funds are tax-free when they are withdrawn, as long as they are used for education. So every state offers its own 529 plan, but you're not limited to using only the state plan based on wherever you're located. You can actually use any state plan out there. The fees and investment options are going to vary plan by plan. And essentially a 529 plan is kind of like an investment account, similar in some ways to a 401k, which is more geared toward retirement investing. The 529 plan is going to offer a list of fund options to choose from. Those funds are invested in a mix of stocks and bonds, kind of depending on your risk tolerance and also depending on your time horizon. So if you're familiar with a 401k plan, you may have heard of or seen a target date retirement fund. So similarly, 529 plans will often offer target enrollment date funds. Those types of investments will automatically rebalance towards a more conservative mix as you get closer to that enrollment date.
Okay, we have a couple of questions in here. So can we address these before we get much farther?
Yeah, of course.
So this is a great question. Is there a minimum to open a 529 account?
Not at all. No, I should say it may depend on the plan that you choose, but I don't believe so. I've used Utah's 529 plan or helped somebody open a Utah 529 plan, and it's $10. You can invest $10 in the 529 plan, but it may depend on the plan itself. Sometimes there are different characteristics, just like there are different fees and investment choices. They may have their own specifications, but that's a great question.
Yeah, we have another question in here, and then I know we're going to cover it in our next couple of slides, so I'll make sure that gets addressed. Let's just keep going.
Okay. So each 529 plan, it has its own owner. That's usually a parent or grandparent, a guardian, and a beneficiary. Usually that's the child. But parents, grandparents, friends, anybody can contribute to the plan. There are limitations, some limitations on those gifts, though. The IRS annual gift tax exclusion amount in 2023 is $17,000. So anyone can contribute up to that amount without having to file a gift tax return. Now, there's one exception, this special election that you can make. It's often called super funding or 5-year gift tax averaging. That allows a person to use 5 years worth of annual gift tax exclusion amounts. So, for example, using today's numbers, somebody could contribute up to $85,000, which is 17,000 times 5, in one particular year. The caveat is that this person cannot contribute anything for the following 4 years. So why might somebody want to do this? Again, the more that is invested early, the better the benefit, because the benefit to a 529 plan is that there's no tax on the growth. We've addressed the question about minimums. I do want to mention there are generally maximum account balances that depend state by state. It is quite large, though. It's in the range of $200,000 to $500,000, depending.
Yeah, I didn't even think about asking about a maximum. No,
Yeah.
I know we're going to talk about what you can use the money for. Another question here, is that $17,000 a year per person? So if they had 5 children they wanted to give to, or grandchildren, how does that work?
Great question. So it is per person, and recall 529 plans have a single beneficiary. So if there are 5 children, there will be 5 different 529 plans, and one parent could make $17,000 worth of gifts into each of those 5 plans. So that would be $85,000 across those 5 529 plans. Recall also the $17,000 gift tax exclusion amount applies per person, meaning that if 2 parents want to gift up to their maximum amount, they could each give $17,000. So $34,000 from 2 parents in a particular year.
All right, thanks for the clarification there. Let's jump into what you can use it to pay for.
Right. So the biggest caveat with 529 plans is that they're really geared toward educational savings, and you have some penalties, which we'll talk about if you don't use them for qualified educational expenses. So what are those qualified educational expenses? Tuition and fees, that's probably the most obvious. For college, vocational, or trade school. And actually a couple of years ago, it was the laws changed a little bit to also allow for tuition payments to elementary and secondary school, books and supplies, student loans, off-campus housing, food and meal plans, computer software, internet access, special needs equipment, and in fact, you can pull out funds without penalty for medical reasons, I should mention. What you can't use it for would be things like transportation or travel, health insurance, college application and testing fees, and extracurricular activity fees. On to the next slide for the.
Sorry about that. Couldn't
No
find my
worries.
button here.
So, like I said, there are penalties if the funds are not used for education that are worth knowing about. There's a 10% penalty. The growth is also subject to taxes. So really there are incentives that really direct you to be, incentivized to use these funds specifically for education, and it is kind of a limitation there. There was a new Secure Act 2.0 was passed very recently that may allow for the rolling of some of the remaining funds into a Roth IRA for the benefit of the child. There are some caveats though. The 529 plan has to have been open for 15 years. It is subject to those annual Roth IRA contribution limits that are set by the IRS. And in aggregate, there's a $35,000 lifetime limit on funds that can be rolled. So all things to keep in mind, and definitely ideally want to use these funds for educational expenses.
I had a question here. Do I make a payment from the 529 directly to the college? How does that work?
Great question. It again, it depends on the plan, but that's often most frequently how that's done. You can also make the payment and then reimburse yourself from the 529. It's if anyone's familiar with an HSA or a health savings account, it's kind of a similar process. You do want to make sure that the reimbursement is tracked, so you're not taking out a big payment and going on vacation or something like that. You want to make sure you have those receipts, but you can do either way. And a lot of 529 plans are set up to pay the check directly from the 529 to the institution. Okay, so what if the funds aren't needed? And this can be for any number of reasons, I think. The child the beneficiary may choose a different endeavor other than college. They might get an academic or sports scholarship. So if the funds aren't needed, there are a couple of options as far as what do I do with all of these funds in the 529. You can change the beneficiary. So switch it to another child, maybe a younger sibling or a cousin. Or you as the parent could take a local community college class. As I mentioned, these funds can also be used for K through 12 private education tuition. So if there are funds left over and there's a younger sibling enrolled in a private school, that would be another way to drain the funds for the use of education without penalty. Okay, so that covers the 529 plan. So now we're into the second vehicle that we can use to save for future child expenses, again, including education. So this is called the Uniform Transfer to Minors Act, or sometimes it's referred to as UTMA. This is also kind of known as a custodial account. They're all kind of the same term to describe the same thing. This is kind of like opening a brokerage account for the benefit of the child, where you as the parent or guardian will act as the custodian. So there are a few benefits. One is that you have more investment choices. You in fact can invest in anything that you would like to invest in. You're not limited to that list of choices offered by the 529 plan. The custodian must be on the account until the child reaches that age of majority. In most states, that's 21 years old. Now, this also is potentially a drawback because a child who reaches that age of majority might still not be mature enough to handle a significant amount of assets at 21 years old. The 529, as we mentioned, is really geared toward educational savings and should be used for education, so you avoid those penalties. The UTMA, or Uniform Transfer to Minors Act, doesn't have that limitation, and in fact can be used for anything, education or otherwise.
We are getting some more questions in here about the 529, but I'm going to
Great.
hold them to the end.
Okay.
And we'll circle back after we've gotten through some of this other information, because I think it's important to know that there's other opportunities to save for education outside of a 529.
Right. All right. So the UTMA is, unlike a 529, it is not a tax deferred account. The income that is generated from the UTMA is taxable to the child. So the way it works is it's paid on the child's tax return. So it's subject to kiddie tax rules, which I want to spend a minute to explain. The first $1,250 of income is not taxed. The next $1,250 is taxed at the child's rate, which is usually quite low. Children don't tend to be high income earners. But anything above that, basically the parent's marginal tax rate kicks in. This is to prevent parents from sheltering tons of income into their child's tax return. But the income and the growth are taxable. But as we mentioned, the funds can be used for anything. There's no penalty if they're used for non-educational expenses. But again, this makes the maturity of the child much more important, because there is that flexibility.
Is the UTMA just an account that you open up with your advisor or brokerage? How does that work?
Exactly. Yep. You don't need to go to a specific state plan. You can go to any brokerage firm, usually, and your advisor can help you do this. You can open the account. Essentially, it's in your name until your child reaches that age of majority. But yes, you can open it in any brokerage firm, really.
And so you can go in and say, I want to open an UTMA up for my kiddo. So, okay.
Yeah, exactly. Or custodial account, whatever.
Custodial account. Okay. Very good. All right, let's move on to the third vehicle.
Okay, so the third and final vehicle is an irrevocable trust. This allows more control than the UTMA, which again, the funds essentially become the child's at age of majority. The trust is its own legal entity. It requires that a trust document that must be drafted by an attorney. And generally, when the trust is created, it's going to stipulate at what age the assets are distributed. So if you're setting this up for an infant that you don't know how mature they're going to be at age 21, you might say a third will be distributed at age 25, another third at age 30, and another third at age 35. That's kind of a typical, if you have no idea, that might be what you start with. The irrevocable trust requires a non-grantor be the trustee. So the person who's funding the trust cannot be the trustee. So usually that will be a non-parent who will act as the trustee. Now, what is the trustee? What's their responsibility? This is the person who will control the trust, will essentially have powers of administration over the trust. They have a legal obligation to administer the trust solely for the purposes specified. So in most cases, that will be for the benefit of the child, meaning the trustee cannot distribute funds to pay for their own expenses or to go on vacation. Now, of course, for obvious reasons, you definitely want to name as trustee someone that you do trust if you're setting up this type of entity for the benefit of your child. So similar to the other accounts that we've mentioned, the 529 and the UTMA, parents or anybody can make annual gift tax exclusion amounts to this irrevocable trust. Essentially, then you can, once you have the trust document drafted or signed and created by the attorney, you can then open up a brokerage account in the name of the trust, in which you can then invest the assets. This is a more expensive option, and there are costs involved here to be aware of. It does require that trust document be drafted. That costs money. Attorneys charge generally hourly. It also requires a separate trust tax return be filed each year. And just like the UTMA, growth and income on this irrevocable trust are taxed. And in fact, trust tax rates reach the highest bracket quite quickly. So it is the more expensive of the three options. But I think there's a few reasons that people are willing to pay these higher costs. The biggest is control. As I mentioned, you have more control over when those assets are distributed, and you can assess the maturity of the child, but have kind of those guardrails so they're not going to turn 21 and take all the funds and buy a Ferrari or something like that. This is also a particularly useful tool for parents who might be facing a potential estate tax liability. So I want to back up here and spend a little bit of time talking about the estate tax. In 2023, the estate tax threshold is $12.92 million per person, or just under $26 million per couple. That threshold is expected to decrease by half at the end of 2025. That is, unless tax rules change between now and then, which I'll put aside for now. But basically anything above that threshold is taxed at 40% to the heirs of the estate. So what that means is a couple who might be facing that estate tax wants to get money out of their estate to avoid that very high tax for their heirs. And ideally, they want to do this by getting funds into some kind of vehicle that will ultimately benefit their heirs, but outside of their estate. And an irrevocable trust is exactly that type of vehicle. This allows parents to make those incremental $17,000 per year per person, so $34,000 per couple. Those annual gift tax exclusion amounts can go into the irrevocable trust. The trust can be invested, and those assets can grow over time outside of the parent's estate. I also want to talk about education and healthcare, because these are the only two things that can be paid for in any amount above the $17,000 exclusion limit, and not be subject to that gift tax, or not have to file a gift tax return. So a parent, for example, can make a $75,000 tuition payment in 1 year, plus all the expenses that go along with college. And they can do that for the benefit of their child, and it is not considered a gift by the IRS. Similarly, if they have a unfortunate catastrophic healthcare event that has tremendous healthcare bills associated with it, a parent can make those payments for the benefit of the child. It's not considered a gift. You can't do that for anything else. So you can't, buy a car or a house and just give it to them without it being considered a gift by the IRS. So let's get back to the example of parents who might be facing an estate tax threshold. We mentioned they kind of want to find ways to get money out of their estate. Making a direct payment of a large direct payment of tuition or anything education related is a way that they can reduce that estate tax liability by paying for it directly themselves.
And that's very interesting. I know we're going to round things out here, but I will tell our attendees that I know we have a lot of questions. We are going to get to those soon. And make sure to keep putting those in the comments. Thank you so much, folks.
Yeah, so I think trying to understand which one is right for you. It may not be one size fits. It's certainly not one size fits all, and it may not be there's only one answer. It may be fund a little bit of a 529, but also think about opening an UTMA or an irrevocable trust. I think the ultimate answer depends on your family. It depends on your financial goals or your goals for helping your children. And I think that you want to make that decision in conjunction with consulting a financial advisor. I would definitely recommend querying and interviewing financial advisors to find out what makes the most sense for you and your family.
All right, well, let's go ahead and get into some of these questions. I have a list here already. All right, I'm not sure if you know much about this. Did the availability of funds in a 529 impact the ability to get a scholarship?
Oh, that's a good question. As far as a scholarship, I don't think so. Because essentially, again, my understanding probably depends on the college, depends on the type of scholarship. A scholarship, I think I'm going to just put aside and say probably not, because it's more strict merit-based, or in the case of sports, it would be talent-based. But financial aid might be the other impact here. Without getting too deep into the weeds here, 529 assets are generally counted as parent assets for a FAFSA loan. So the parent is the account owner, the child is the beneficiary in this case. I think something like 5.6% of parent assets are counted as far as how much is available to be paid for college when they're doing a financial aid application. So depending on income, a 529 account might have little to no impact on financial aid. It also might matter school by school, depending on the type of financial aid they accept. So unfortunately, the question is kind of a little more gray and a little bit more depends on the situation, but that's kind of a general how the 529 can impact financial aid.
All right, here's another question. What are the pros and cons of a 529 held in a parent's name versus a grandparent's name for the same, and I'm assuming they meant for the same person or child?
Same child. Yeah, I mean, probably the financial aid is the biggest component there. I think if you want to be, I guess the only thing that would be something to be aware of is if you put it in the grandparent's name, the grandparent is the owner. So it may be that you're giving up some control as the parent. But again, kind of optimizing on financial aid, if that's considered the grandparent's asset, then it won't be considered as a parent asset when you make that application.
All right, here's another question. We've got a lot of questions about 529s. Can you use the funds in a 529 for foreign educational institutions outside of the US?
So I believe so, as long as it is as long as it's an accredited university. That generally is the litmus test for, can I use these funds from a 529 plan? But yeah, I don't see any reason why you couldn't use it for a foreign institution as long as it's accredited.
All right, and then are 529 distributions declared on the tax return? I'm assuming the child's tax return.
No, so I will say I am not a CPA, I'm not an accountant, but no, I don't believe they are. It's a, you know, the IRS will get involved if they're not used for education, but they're not considered a distribution on the tax return. However, for a complete and surefire answer, I would consult an accountant for that question.
All right, I think you already answered this one, but maybe you can talk about, is it possible to use a 529 for yourself?
Yeah, you can. I think this goes back to what we talked about at the beginning, as far as the biggest benefit to a 529 plan is that future appreciation or future growth on the invested assets. So we do get this question sometimes where people say, well, I want to go to cooking school or, you know, flight school or some accredited university or community college class. I want to go next year. Should I open a 529 plan? And the answer to that is you could, however, we're only talking about a 1-year horizon of growth. That also, when you invest over a long period of time, you can kind of bake in an assumption of average rates of return. But as we've seen with the market decline last year, you could see a decline. So you wouldn't want your funds to necessarily drop in that particular year. So I think if you're thinking that in 5 to 10 years, you may want to go back to school, I would say that's probably a good idea to maybe put something into a 529 plan. But if you're thinking, I wanted to go to school next year, I don't know that I would make that unless you get a tax incentive from your state. That's my opinion, though. So I would say consult your financial advisor.
Right. All right. You said every state has a 529. Are some states better than others? Can you talk about why? What is it? How do you research what is the best state for you?
Yeah, that's a great question. I think generally looking for lower fees and better investment choices. So the fund list that I mentioned that the 529 plan will offer, you want to look for something that doesn't have really expensive funds. So sometimes you might say, well, this looks good, I want to invest in this, and then it has a really, really high expense ratio, which is the fund fee associated with it. So I would look for something that has low cost funds that you can invest in. As far as one state being better than the other, I'm hesitant to say, use Utah's plan. I think it just kind of depends on what you're looking for. I think it also is important to note whether you do need to use a particular state's plan if you live in that state and want the tax deduction that they offer. But those are the two things that I would look for are low fees and good fund choices.
And your financial advisor would be someone who could really help interpret that, I'm sure.
Exactly. Yes.
All right. This is a question about getting the funds in your 529 or sending the gift. How is that handled if it's tax deferred, if you're taking money from your after tax paycheck? How does that work?
It's when I say tax deferred, it's really the growth on those funds is not taxed.
Okay, the growth. So
yeah,
the principal that you put into the fund, that's after tax.
Unless you're getting a deduction from the state. Correct. Yeah.
Okay.
Yeah.
Well, I think that's all the questions that we had in the hopper so far. If I missed your question, go ahead and put your phone number in there so that we can reach out to you after this event. But I want to thank Darcy for being here and also for this great information. We've gotten some thank yous already in the chat. To our attendees, look to your email soon for a link to the replay of this event. And you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thanks so much, everyone, for coming, and we'll see you at another webinar soon. Goodbye, everyone.